This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Donating Retirement Assets, Part 2, Giving at Death. This is Professor Russell James. Giving from retirement accounts during life often may have negative tax consequences, but in some cases, such as a qualified charitable distribution, may have distinct tax advantages. Charitable giving from traditional retirement accounts at death, in contrast, is almost always more beneficial than giving other types of assets to charity at death. Traditional retirement account assets are tax-heavy for heirs. Not only are these assets subject to gift and estate taxation, but they are also subject to income taxation. The money in these traditional accounts has never had income taxes paid on it. Therefore, income taxes must be paid when the funds are withdrawn. This tax burden makes these tax-heavy assets less desirable for heirs, but it does not make these assets less desirable for tax-exempt organizations, because these organizations do not pay such taxes. Therefore, it is always to the heir's advantage and not to the disadvantage of charities to make as much of the charitable share of estate assets as possible consist of traditional retirement accounts. In other words, qualified plan money. Consider this simple example. A donor has only two assets, a $1 million IRA and a $1 million house. The donor wishes to leave half of her estate to a charity and half to her child. The child earns a high income and is a resident of California. Does it matter which asset the charity inherits and which asset the child inherits? If the child inherits the home, the child will receive the $1 million asset free from any taxation. There are no estate taxes because the donor's estate is too small. The child can sell the asset and spend the entire $1 million. The results are quite different if the child instead inherits the $1 million traditional IRA. The assets in the IRA have never had income taxes paid on them. Thus, withdrawals from the account will be treated as additional income to the child. Assuming the child is paying the highest income tax rates at both the state in California and federal levels, this leaves slightly more than half of the money available to the child after paying income taxes. Notice that this massive difference in taxation occurs simply by the donor's selection of which assets to leave to charity. The difference occurs even though the donor's estate is not subject to estate taxes. Although the difference would be less if the inheriting child were in a lower income tax bracket, it would still be substantial enough to warrant selecting the retirement assets instead of other assets for the charitable estate gift. Retirement plan death beneficiaries are typically named in the beneficiary designation of the retirement account. In other words, the donor's will usually does not control the distribution of these assets. In fact, the will is best thought of as a backup document in general because it will not control any assets with beneficiary designations or owned in joint ownership with the right of survivorship. Good retirement planning beneficiaries include any public charity and any private foundation. Charitable remainder trusts, which are also charitable entities, may also make good beneficiaries, but with some additional consideration. The unpaid income taxes on the retirement account funds will cause the retirement distribution to be considered income in respect of a decedent, also known as IRD. This IRD treatment is important if it is paid to a charitable remainder trust because it makes the retirement distribution funds ordinary income assets. Ordinary income assets must be paid out first, in other words, they are Tier 1 income, prior to paying out any capital gain, non-taxable income, or return of principal. When paid out to non-charitable beneficiaries, the IRD will be taxable to the beneficiary as ordinary income. Thus, to the extent that the retirement assets are ultimately paid to non-charitable beneficiaries of a charitable remainder trust, the tax advantages of leaving these assets to a charity disappear. Another issue also arises regarding a potential income tax deduction. Typically, if a beneficiary inherits an IRD asset, such as an IRA account, the beneficiary is entitled to an itemized income tax deduction in the amount of any estate taxes paid as a result of the transfer of the IRD asset. For example, if Jane inherits a $100,000 IRA account, which generated $40,000 of estate taxation as compared to the estate taxes that would have been owed had the asset not existed, Jane will receive a $40,000 income tax deduction. The idea here is to avoid taxation of dollars that have already been taken by the IRS in estate taxes. In theory, this same deduction applies to the non-charitable portion of the charitable remainder trust. The estate pays estate taxes on the taxable portion of the IRA transfer to the charitable remainder trust. In other words, the present value of the share that will not be going to charity. These are the estate taxes paid on IRD and thus generate an income tax deduction. However, this tax deduction is treated as return of principal inside the charitable remainder trust, meaning that the deduction will not be distributed to the beneficiary unless all other ordinary income, capital gain income, and exempt income held in the trust is first paid out. The net effect of this is that the income tax deduction resulting from the estate taxes paid on the IRD will most likely be completely lost if that benefit is paid to a charitable remainder trust. Problems can arise when naming a charitable lead trust as beneficiary of a retirement account. The charitable lead trust is not a tax-exempt entity. Thus, it must pay income taxes when receiving the retirement account funds, just as any other taxpayer would, although perhaps at even higher tax rates due to the compressed tax schedule of complex trusts. Naming the estate as beneficiary, even if the estate will make charitable distributions, could result in the estate having to pay the income taxes on the retirement account funds. This can arise if the account holder specifically names the estate as beneficiary, or if no beneficiary is named, which will also cause the retirement account to pay to the account holder's estate. Typically, if the estate receives IRD, such as qualified plan money, the estate must pay the income taxes resulting from this IRD. However, this can be avoided if the estate transfers the right to receive the IRD to fulfill a bequest of that specific item or of a share of the remaining estate. In that case, the recipient, not the estate, would owe the income taxes on the IRD. If the recipient is a charity, no taxes will be owed. This result is possible if the estate documents allow the executor to distribute assets on a non-pro rata basis. In other words, if the executor can send a disproportionate share of the IRD asset to the charitable beneficiary. However, if the assets are used to fulfill dollar amount charitable bequests, in other words, estate gifts of a specific dollar amount, the estate will still have to pay the income taxes due from the IRD retirement account asset. Finally, if the retirement account is to be divided between charitable and non-charitable beneficiaries, the non-charitable beneficiaries have until the end of the next year following the decedent's death to establish separate accounts for the charitable and non-charitable beneficiaries. This is not necessary if the charity share is completely paid out prior to September 30th of the year following the decedent's death. Creating these separate accounts is important because if the charity is not paid off or separated out, it will reduce the maximum time allowed for the non-charitable beneficiaries to remove the funds, with income taxes being due at the time of the removal. These separate accounts may not be possible if the amount designated for the charity was listed as a dollar amount rather than a percentage amount. However, such separation of accounts will not be needed if the administrator simply pays off the entire charitable portion prior to September 30th of the next year following the decedent's death. This complexity can also be avoided if the only other beneficiary is a spouse, because a spouse can simply roll over his or her share into his or her separate IRA. Naming someone other than the spouse as a beneficiary for an ERISA account, such as a 401k, a simple IRA, a SEP IRA, an ESOP, or profit-sharing plan, requires consent from the spouse. Thus, a charity may not be named as a primary beneficiary without the consent of the account holder's spouse. Such consent is not required in a traditional IRA or Roth IRA unless the company managing the account decides to add such requirements. Estate gifts of retirement account assets, of course, require that the accounts have value after the death of the account holder. Thus, traditional pension plans, in other words, defined benefit plans, are not directly relevant for charitable planning purposes because no valuable assets will survive the death of the participant, or in some cases, the death of the participant and the participant's spouse. Because of their creation and administrative expenses, charitable remainder trusts are generally reserved for substantial transfers of assets. One way to conceptualize a qualified plan with a charitable beneficiary is like a mini charitable remainder trust with minimal administrative costs. In both instruments, the charity receives the assets at the death of the donor. Both allow tax-free growth of assets, and both can provide income to the donor. In the charitable remainder trust, the income is fixed for life, whereas the qualified plan provides income at the discretion of the donor and without a 10% penalty after age 59 and a half. The charitable remainder trust reduces income by the share of the transfer representing the present value of the charitable interest. The qualified retirement plan reduces income by the entire amount of the transfer for qualified taxpayers. Of course, a retirement account can be funded only with cash, and there are limits to the amount of funding allowed. The charitable remainder trust can be of unlimited size and can be funded with appreciated assets and thereby postpone or eliminate the associated capital gains taxes. In cases where a donor is attracted to the feature of a charitable remainder trust, but where the nature and size of the potential gift does not warrant its use, it may be helpful to consider naming a charity as a qualified plan beneficiary as a type of mini charitable remainder trust substitute. This has been Donating Retirement Assets, Part 2, Giving at Death. Join us next time for Donating Retirement Assets, Part 3, Roth Conversions and Charity.